Good afternoon and welcome to another webinar being hosted by Grip Invest. This time on a topic that is incredibly topical and has been in the news for several months, in fact, probably over a year, when it comes to financial today about the trends where we are seeing the regulatory action in the MFI space and how it impacts NBFCs who are providing microfinance loans, as well as investors looking to invest in the space. I'm excited to be joined by Karthik. Karthik, in his role at ICRA, where he's the group head of financial sector ratings, could not be, you could not have a more informed and educated person who is tracking this on a day-to-day basis to join us and talk to us about the trends that they are seeing. Karthik, welcome to the webinar and thank you so much for taking your time for having the session with us. Karthik, I just
Thanks
want
for
to
the
make perfect. Great. I just want to make sure I was audible. Um, Quick housekeeping notes for everyone. Wherever you're listening to us, whether it is YouTube or LinkedIn, you will find a chat box. Please feel free to use that to send us comments, questions, and we'll definitely pick it up during the webinar and make sure that we all understand the developments in this space better. Karthik, let's start by setting some context so that everyone can understand what is the size of data that you are seeing and how that will flow into this conversation today. Could you just help, for the layman, explain what is it that ICRA does as a rating agency, and what is the size or scope of the NBFC business, specifically MFI business, and how does it impact NBFCs and Tushar, Karthik, can you hear me?
Yeah, I can hear you now. So I lost you in between.
Perfect, Karthik.
So hi, as a credit rating agency, we are basically involved in rating of bank loans and capital market instruments. Purely from an NBFC side, I head the ratings for the BFSI sector. We cover 300 plus credits as on date. Talking specifically of NBFC, we have a portfolio of over 180, 190 odd pure play NBFCs, which includes NBFCs, HFCs, microfinance institutions. Talking specifically of microfinance institutions, we have a rating on about 16 NBFC MFIs as on date, and we almost cover all the large ones in the industry.
And Karthik, is it fair to say that with respect to this set of both NBFCs in general and NBFC MFIs, this coverage has been there for a fairly long period of time and fairly consistently?
Yeah, we've always been having a very good coverage on the BFSI sector. So our coverage as a rating agency on banks, NBFCs, MFIs, we've had a pretty good coverage, and that continues over the years.
Perfect. That's great context because while there can be a lot of noise on any one sector or developments, what I wanted to establish for everyone was that the perspective you bring is having studied this sector for years and looked at it very closely in your capacity as a rating agency. Let me now dive into the MFI sector and get your thoughts on how large the sector has now become in terms of total lending and what, in your view, has driven the recent growth in the business.
Uh, MFI lending has become fairly big over the last couple of years. If you were to look at the industry, MFI loans are given by both NBFCs, microfinance NBFCs, and then also by banks. So in that context, our estimate of an aggregate MFI portfolio is about 6.8, 6.9 lakh crore as of September. Of this, banks also provide MFI loans by way of a self-help group direct bank linkage loans. That accounts for about 2.5 lakh odd crore. So pure play, as we understand, MFI loans, banks plus NBFCs would be in that vicinity of about 4.1, 4.2 lakh crore. Our estimate is marginally lower than the numbers that we saw in March 24. Obviously, given the set of challenges and the negative news that we've been hearing in the course of the current financial year. Again, if we just dive down into NBFC, pure play MFI loans out of the 4 odd lakh crore, roughly 2 odd lakh crore would be by the NBFC sector and 2 lakh crore by the banking sector. To put it in a broader perspective, banking sector credit growth is of the order of about 170 lakh crore. NBFC exposure, it's about 45 odd lakh crore as on date. So, if you look at the overall MFI portfolio for the entire system, you can say that it's about 3 odd percent of the overall system. Bank credit of about 175 lakh crore plus about 45 lakh crore of NBFC. Of that, you have about 6.8, 6.9 lakh crore as MFIs, as microfinance loan. If you were to just look at the NBFC space, it's about 2 lakh odd crore out of about 45, 46. You again still come to that 3.5% kind of a loans exposure towards this particular sector. So that's how the market is, and it has seen a fairly strong growth over the last couple of years before the slowdown in the current year.
Understood. And you spoke about this slowdown. What, in your view, is driving the slowdown, Karthik?
Couple of things one can say that's the cause for the slowdown. Last 2 years, last 2 3 years, the industry has grown pretty robustly. If you were to just look at numbers, if I'm right, in FY23 the industry grew probably I'm at 38, 39% odd. FY24 it again grew at 30 odd percent. So again, you know, one also needs to understand that these are relatively short tenor kind of loans that one gives. Bulk of the loans are within that 18 to 30 months kind of a tenor. MFI industry began quite some time back, wherein the loan tenors were generally about a year. Then it sort of, you still had a slice higher proportion going to 18 months to 24 months. Now you have a fair bit of loans extended for that 2 year, 2 to 2.5 year kind of a period. It still is relatively short as compared to some of the other retail assets that you are able to sort of lend to. On the back of this fast growth, plus the additional challenges in terms of leverage levels going up for the household sector, for individual borrowers, obviously salary growth has not kept in pace with that, plus a bit of slowdown in the economy and rise in delinquencies. All these have played their own small roles in terms of slowdown in the current year. Clearly, the pressures around asset quality and rise in delinquency, which one started seeing in the first quarter of this year, that's been the key reason for the lenders in this sector to suddenly get a bit more cautious. And a marked slowdown is clearly visible in Q2 and whatever we are at least hearing from the market in the current quarter as well.
Understood. It's interesting you talk about the tenure of the loans. I did want to bring that up towards the later part and link it to till when we see some of the NPA expected stress happen. But I'll come back to that. I'll pick up a question that's already come on the chat box, which is to just help quantify how much of the slowdown has happened. Is it year on year about 10-15%, or is it even more than that? And would you attribute some of the regulatory action that RBI has taken to also be a factor in this slowdown?
See, it's these businesses are also cyclical. Very difficult to get month on month numbers. It may not give a true sense. You should probably need to take a slightly longer perspective. Our estimate is that the portfolio as of September 24 for the industry is at about 5-6% lower than the March 24 portfolio. So as compared to, if you look at a YOY number, you're possibly still 10% over, 10-11% over September 23 numbers, but clearly on a sequential 6 months, you are down. This is again driven by slowdown in disbursements and also write off on portfolios because of asset quality. The the slowdown in disbursements is a function of a couple of additional things as well. We also had the MFIN, the self-regulatory body, advising its members to sort of tighten their underwritings, put in certain guardrails, because one did see or get some data that the underlying borrower segment one has seen a bit of a over leveraging, and an over leveraging does cause accidents at some point in time. you know a lot of entities already have their processes in place wherein you're doing a lot of checks at the time of sanctioning or disbursing the loan, but clearly, as a lender, you have no control on the borrower not taking a fresh loan. Neither do you have control on your competitor who who may extend another loan depending on their own risk appetite and risk reward return expectations that they have. Now, as a body, what we understand is the regulations or the advisories there to tighten and adhere to certain basic guardrails. This clearly has resulted in a lot of MFIs and also banks slowing down on their disbursements. Slowing down in the sense there is a lot of rejections of proposals which are coming onto their table because some of these metrics are not being adhered to. So that's really causing the slowdown out here. Subsequently, last month, MFIN again further tightened the norms for the existing members, and these would again be applicable from 1st of Jan 2025. So in all likelihood, we could probably see Q4 also some slowdown. I mean, one needs to just factor in that for any lending business, Q4 is really very, very active and very busy season. So it's on that period when you are going to tighten your lending norms. So you could probably see some slowdown, and that's the reason we really not expecting the AUM for the industry to really grow in FY25. I guess our estimate as of now is we'll be lucky if we have a maybe a 5% growth in AUM by March 25. Though the downside risk is still high as we speak. I mean, this is in relation to almost close to a 29-30% kind of a growth that we saw last year, and about 37 or 38%, if I remember right, the growth that we saw in the previous financial year.
Understood. Okay, no, thank you for putting those numbers for us. If you were to combine, Karthik, what you said in the last two answers, where there has been a slowdown in disbursements starting from the March quarter, and it's been a slow slowdown, maybe a single digit slowdown, and in fact, if I remember, RBI's first action as a very active regulator was in November December 23, where they changed the risk weights, or they gave guidance for banks to look at MFI loans differently. And then you say also talked about the fact that the average tenure on these loans is anywhere between 18 to 24 months. Do you feel that from an NPA standpoint, or from a seeing the performance of previously given out loans, we may see all of that play out in the next 3 to 6 months?
It's very likely that you will see asset quality stress over the next couple of quarters. Before I elaborate on that, the point on RBI regulations of last year. RBI increased the risk weight on lending for unsecured loans. RBI increased the risk weight on bank lending to NBFCs. But given the importance of MFI sector in financial inclusion, given the importance of housing finance industry, RBI did exclude these two segments from the increased in risk weights. So directly, those regulations did not impact MFI. I guess the bigger challenge came to them when starting Q1. You had elections. There've been arguments on excuses around heat wave, which caused a lot of challenges in collections during Q1. You also had intermittent rains and floods in some part of the country. All these in addition to issues related to over leverage. See, what's also happened is we were coming out of COVID. So COVID saw a stressful period across the sector, and this was a period when you've also seen the digital play, escalate and significantly ramp up. So while it has been good from the lender's point of view to underwrite credit digitally basis lot of data that they can get. It's also been easy for borrowers to avail of loans from the system. So possibly somewhere the leverage levels have gone up, and with economy showing some signs of slowdown, salary levels not increasing, possibly it had all started showing up in delinquencies, as it would normally happen. You started seeing these delinquencies in smaller ticket unsecured loans, personal loans. It's now sort of effectively spilled over to MFIs as well as we speak.
Understood. Maybe just to help explain some of what we're talking about, which is the linkage between banks and MFIs. The reality is that um, while banks also provide MFI loans, when we specifically talk about NBFC providing MFI loans, these NBFCs end up raising money from banks as one of the largest sources of financing. Um, and what Karthik is talking about is where RBI has both formally and informally made it harder or made it less lucrative for banks to provide loans to the MFI sector. Karthik, now we all understand that NBFCs raise money through various means. It could be a loan, it could be a direct assignment, it could be a PTC, or what many of our users on our platform are familiar with as a term as SDI. Have you also seen the mix of this financing change between the various sources from an NBFC and bank?
It depends on the NBFC and the bank. Clearly, one way to look at it is these are all various venues to raise funds. Now, what really happens is it's a function of pricing. It's a function of what the investor or the lender wants. Now, term loans, given that RBI has been asking banks, asking larger NBFCs to go slow on lending to NBFCs in general. So there is a preference by some of the banks that, okay, you want funding from me, I'll give you part by way of term loan, part I'll give it either by way of PTC or direct assignments. So there's always a play around that. And finally, it also depends on what is the strategy of the respective banks that you're talking about. As far as the MFI is concerned, for them it's a trade-off between, if it's an on-balance sheet kind of a borrowing, there is an impact on capital adequacy. You do a direct assignment or a PTC, you have some benefit on the regulatory capitalization front. On a direct assignment, given the accounting norms, you are also able to book upfront profits. So it depends on the combination between what the MFI wants and what the bank is willing to provide. And that's how the mix changes. But generally speaking, what we have seen at an industry level is the off balance sheet DA, including PTCs, if I should say so, they account for about one fifth of the overall funding that a MFI gets. It could be high or low depending on a specific entity that you're talking about. But at a broader, at a sector level, if there's a total AUM of, let's say, 100, you have an equity of 20. So out of the 80 rupees of borrowings, you'll probably have about 60-65 by way of a pure vanilla term loan or an NCD, and then the balance 15-20 would be by way of off balance sheet exposures or PTCs. So that's how is the broad mixes. We really don't see that to change materially, though I wouldn't be surprised if a couple of entities have a greater reliance on off balance sheet as compared to some other set of entities.
Understood. It's interesting to note that it hasn't changed, and we'll wait to see. There is definitely I think outside of this space, outside of just MFI, I think there are definitely different forces, as you mentioned, about why someone would pick one source of financing, and that probably impacts irrespective of whether it's an MFI loan, personal loan, or other forms of loan. I did want to come specifically to talk about how the PTCs are performing, because that's an instrument that many of the users on Grip do explore. Um, could you talk about, in general, the PTCs that have maybe been rated by ICRA specifically for MFI loans? What is the performance that you are seeing? Are there signs on things like delay, default, collection efficiency, or dip into the security package, cash collateral, that you are noticing? Anything that has significantly changed over the last 6 to 12 months?
Um, just to reiterate that, as a rating agency, we're pretty active on that space in terms of rating of PTCs, especially on the MFI side. Our experience has been, as we are seeing stress in the sector, clearly the delinquency numbers are inching up on those uh, parts of the transaction as well. But one thing to be noted is when normally entities or investors pick these pools for securitization, there are a lot of additional filters which one normally puts in. So very simplistically put, one would not be wrong in having an assumption that the pools that come up for, or the underlying contracts that come up for under the securitization or the PTC, would be cherry picked as compared to the overall basket of loans that the MFI would be originating. So, put things in perspective, yes, one can definitely argue that these should be and rather could be slightly better quality kind of a loans, number one. But given the environment, clearly there is rise in delinquencies that we are seeing out here as well. I do not recollect we having had to downgrade any pools in the current year, at least basis the recent developments, purely on the fact that the ratings and the credit enhancements still remain fairly conservative. There is a lot of over collateralization or credit enhancements which is built into these particular pools. More importantly, as we've been talking since the beginning, microfinance loans are relatively short tenor kind of a loans. 2 years door to door, 2.5 years door to door. So your average tenor is just about a year or a year and a quarter. You need some seasoning before you actually sell down these pools into a PTC kind of a route. So effectively, the weighted average life of an MFI pool is just about 7, 8, 9 months kind of a thing, more often than not. So in that sense, the rundown on these pools is also significantly higher. So the build up in the credit enhancement, which is there, as every month you keep getting your collections, that credit enhancement only goes up. So even though there is some rise in delinquencies, the senior tranches that are rated, they still continue to remain where they are, if not getting upgraded because of the further enhancement on the credit build up. So I'm not seeing any stress, at least at this point in time. But surely, if it continues for a longer time, then some of the transactions which possibly got originated early part of this financial year, could see some higher amount of stress as compared to some of the other transactions.
Got it. We'll dive deeper into some of the things that you said that help protect a PTC pool, because some of those are more jargons and concepts that will require explanation. But I'll take a minute and I'll just try to share my screen on what we are seeing at Grip for the MFI loan pools that we have executed on our platform. If you can see my screen, and I'm sorry, it's an Excel file, so I'll try to zoom in as best as possible. A couple of numbers that I thought would be interesting for all of us to take away on. As at Grip, we have done about 80 CR of transactions where the pools are MFI pools. Out of that, 500 are still ongoing, and 333 have completed 333 million, so 33 crores have completed their full life and paid out. We didn't see any delay or default in any of these transactions. As you will notice, this covers nearly 10 different NBFCs that are in this space. As you know, as Karthik talked about, the typical tenure is maximum of 24 months. So actually, the tenure of this transactions was 16 months. They also had some amount of uh, uh, loan already been paid out beforehand, so it was partially already paid out. And then we have now seen another 7 months of the loans being lapsed with only 9 months of tenure remaining. In none of these transactions have we seen the cash collateral get dipped. And as of today, combining both the over collateralization and cash collateralization uh, on a cumulative basis, these transactions are more than 2x covered on the outstanding principal. So while the going in coverage was about 1.3 times, but because of the loan, about 43% of the pool has got amortized, or 43% of the pool has got paid out. The security cover keeps enhancing, and this is one of the attractive features of a PTC or an SDI, where the security cover keeps increasing over time. Even as we look at delinquency data, DPD data, on a weighted average basis, the cumulative delinquency is the DPD data we've seen is about 99% is 0 days, with very little coming in the DPD in subsequent periods, and the cumulative collection efficiency has been 99.4%. Um, to what we are seeing in the industry and what Karthik talked about, there has definitely been some increase in delinquency, and that is reflected in lower collection efficiency. So while we were seeing nearly 100% collection efficiency up till July 24, in the last 4 months, we have seen some dip in it to now reach 94% levels. What you know Connecting what Karthik said to what we are seeing, because these pools are cherry picked, where the loans are set with a higher CIBIL score, there's a higher degree of diversification, and a very strong security package. We're probably seeing much better collection efficiencies than the overall sector. And this is, I'd like to believe that this is true, not just for GRIP, but just generally for PTCs, which is the strength of the instrument. And then combined with a strong security package, it means that there's a lot of protection that's left in the hands of the investor. Karthik, I'll just, I haven't shown you this data before, but any quick reactions here, any observations that you would like to make from this data? Anything to add?
No, it's lastly what I'd also said. We're clearly seeing some dip in collection efficiency in the recent months because of the environment. But as far as the PTC senior holders are concerned, given that the credit enhancement levels are strong, there has been a very sharp amortization and a rundown of the PTC principal. The ratings remain where it is. If not, not getting upgraded over the last few months, we've not really seen any negative actions. Uh, so to that extent, fine. I won't take as possibly transactions which we have done early part of this financial year. Those would have not seen so much of seasoning before they got sold down. So those kind of transactions would need to be looked at closely or monitored closely. But otherwise, given the short tenor and fairly adequate credit enhancement that gets built into these transactions, more often than not, that the senior investors should really be protected.
Yeah, I think that's what's making us as a company more excited about PTCs as the way to look at MFI loan pools or microfinance versus any other structure in terms of investing in them. And the performance of the roughly 80 crores that we have done in the last 12 months gives us a lot more confidence. That said, I think it's definitely about picking the right pool, picking the right NBFC, and doing a lot of work to make sure you have the right counterparty and right security package in place before making a transaction happen. But it's encouraging to know that you are seeing similar data across your wider set of information. Um, I wanted to, you've also seen a few other events or macro events that impacted NBFCs in general, not necessarily microfinance. We saw demonetization in 2016, we saw the NBFC crisis in 2018, and then COVID in 2020, 2021. As you look at this period of time, and you compare the performance of PTC pools across the board, is the same logic applied, which is that because of cherry picking and security package and faster principal repayment, generally the PTCs have performed well?
Generally, yes, but it's a couple of nuances that one needs to sort of bear in mind. When you're investing in a PTC, the security is only the underlying loans, right? You can't expect money from the general corporate balance sheet of that particular entity. The entity may be doing very well, but unfortunately, the pools which got securitized, if they are not doing well, then the investor faces a loss, right? So that's something that cuts both ways. before I just answer it in more detail, you could have instances where, in a certain instance, the entity gets into duress, but the PTC holders are safe because the underlying pools continue to service the loans on time, and then the PTC investor is protected. These are any case off balance sheet through an SPV structure. Yet the converse can also happen. Entity is doing pretty okay, but for an unfortunate or other reason, this particular pool is not doing well. So the general creditors or the general lenders to the NBFC gets paid on time, but this set of investors would probably lose money. So this is what we have seen in the past when you spoke of certain instances, whether it is demon or a GST or other stress which the industry faced. We did have instances where some of the PTC ratings had to move to default. Again, there would have been recoveries at a later point in time, but as you all know, ratings need to be done on a probability of default basis. So the moment there is one payment which gets missed for whatever reason, we are bound to make that rating into D and keep it at D till the money is really recovered. So in the past, we have definitely seen a handful of transactions which have gone into default because of this. And in certain CDO kind of transactions, where we've also seen because of default of the underlying entity, some transactions have failed. But by and large, I think the PTC ratings or the PTC rating, at least in the Indian market, has by and large held up.
Understood. Okay. No, that's encouraging to know. And without doubt, all instruments come with their own level of risk and their own level of nuance. It's something every investor should be aware of. And sessions like this, where we can hear from you directly, always helps set the right context. Maybe a couple of last questions before we move to the questions from the audience. Um, as you look at, and you spoke about the role that the SRO, which is MFIN, is playing. We spoke about what RBI has taken as action. As you look forward into the next 12 months, what are some of the changes that you are expecting in the MFI industry? Is there something even more significant that should be expected at an industry level, or are you expecting a little bit more tweaking and then growth should resume?
I think in the near term, there should be some slowdown because of tweaking. Clearly, from a regulator's point of view, what we understand is uh, some concerns around uh, lending rates, though the regulator is never articulate and fixated on a number. But what we hear is at least a couple of entities or couple of instances, they have sort of given their view on interest rates being charged on certain products, and then the way numbers are getting computed. So that's something, one seeing how that plays out. Second is because of that, because of the environment, clearly the SRO has asked its members to sort of tighten the underwriting and don't go overboard. So while that's definitely a good measure for the industry over the medium term, but in the near term, that would lead to some levels of stress. You need to understand it from a different perspective. On one hand, if we are talking of over levered borrowers, hopefully their hope would have been, okay, I can possibly borrow from somebody else and repay my earlier lender. Now when suddenly the entire industry says, no, I'm not going to lend additional now, so that could definitely lead to some levels of stress for the underlying borrower,
Understood. Okay.
which which would definitely get resulted into delinquency numbers or NPA numbers for the lending institutions as well.
Yeah.
So we do see that pain over the next couple of quarters before things sort of stabilize. The good part to an extent is that over the last couple of years, many entities have been able to strengthen their capital base. The leverage levels are still under control. uh, Many of them do have to follow the RBI LCR norms, so liquidity is also fairly adequate. And then most importantly, a lot of these assets do qualify for various categories of priority sector lendings for banks. So as long as the asset quality is fairly okay, they should be in a position to get funds from the system. Growth possibly would come would start kicking in only after a couple of quarters. At least at this stage, it seems to be a sort of a pause after 2 years of rapid growth for the sector.
Understood. One of the other things that I often hear people say is that the credit infrastructure in the country has rapidly improved. There are more people who are digitally connected. There are more, income tax coverage has increased. There are CIBIL has become something which is more dominant. There are more and more ways for a lender to take action in case there's a default, uh, etc., etc., right? And all of these small things have added to lower tendencies to delay or default on payment from an individual borrower, whether it's an unsecured loan or whether it's an MFI. Is that something that you also hear a lot of lenders talk about? Maybe there's no, not providing specific evidence, but just as a general theme, is that how lenders feel?
So clearly, that's how one really felt. I mean, clearly the credit landscape in India has changed dramatically over the last 5 7 years, especially thanks to the digital play around the sector. So clearly, the ability of institutions to underwrite credit, get access to data, do a quick turnaround, help out on customer service, all those have definitely helped the sector. But the moot problem which comes out is, uh, lending is easy, collection is something which is not. What we've seen over the last couple of years is there has been significant focus on digitalization, on the underwriting uh, part, but collections part, you should try to assume that everything would come digitally. I don't need to invest a lot on the collection infrastructure. I guess last couple of years have sort of provided us with the insight that you can't ignore that. You
Yeah.
can't completely depend on third parties to do collections for you. You need to have a decent collection infrastructure in place. Clearly, with the digitalization, awareness around credit information companies, awareness about ratings, what happens if your credit score goes down, you will not be in a position to get funds from the other players and all that. Those have definitely helped as far as the behavior is concerned. But then, you just look at it from a different lens. Either the borrower or a lender or a combination of two, we are in a situation where we are in the current financial, we're talking of over leveraging.
And just to clarify here,
Right.
the over
So when you're
leveraging,
got into over leveraging, then if I don't have money, I don't have money.
yeah.
So there you are seeing that stuff. But yes, if I was to just ignore this part, we have definitely seen that behavior both from the borrowers front as well. Okay, awareness that if I don't repay my borrowings on time, my score will get impacted and my ability to avail funds in future will also get impacted. That has no doubt helped a lot, but certain other factors have still ensured that the borrowers don't have a choice, but they have started defaulting on some of the loans that they've taken in the past.
Understood. Okay. No, thank you for that. I'll move to a couple of the questions that we have on the chat box now. Um, Number one is, and this goes back to the NBFC banking relationship for source of finance. Are you seeing banks generally pull back on limits for NBFCs, which is forcing them to return or repay their loans, or is it more of there's a sense of caution? It's not that the source of money from banks has gone away. It may have reduced, but it's not completely disappeared.
Now, clearly, with RBI asking banks to slow down on credit, slow down on lending to NBFCs, there is a marked slowdown of lending from banks to NBFCs in general. So, if you look at the data which RBI gives on a monthly basis, the sectoral data, the degrowth, in fact, the bank exposure to NBFCs as of October is lower than the March numbers. So clearly there is a slowdown in that space. Having said that, again, as any prudent lender would do, the moment you are seeing stress in certain sectors, you would want to be a bit cautious when you extend new loans. So which is the same which is happening on the MFI piece as well. So lender with some of the entities showing rise in delinquencies, banks themselves seeing a rise in delinquency on their own MFI portfolio. So clearly they are seeing stress in those portfolio. Forget MFIs, their own portfolios which cater to the similar borrower profile. They are seeing some stress. So it's a matter of prudence from their end as well to be a bit slow, be a bit cautious, and given from again from an MFI's point of view as well, with all of them trying to sort of confer to the MFIN guidelines and guardrails. So they themselves are also going slow. The focus is more on collections rather than they're just chasing growth, at least in the current juncture. So it's a combination of all these. You can't just say that the banks have stopped lending. It's a mix of all these factors at play.
Understood. A question from Nikhil Ved. What is the current or what is the general level of NPAs that you're seeing today across the MFI loans, whether it's NBFC banks? Could you give some range?
In terms of NPAs, what we are seeing is clearly the numbers are going up. Just a sec. Our numbers on NPAs, till March, the 90 DPD numbers, let's say for the MFI industry, was been in that order of about 2.2% kind of a levels. They have, our estimate as of September end, jumped to over 3.4%, and then this number is likely to go up further during the current year. So delinquency numbers have definitely gone up. Percentages could also be a bit misleading because the denominator has also shrunk in the current year. It's ratios are a function of both numerator as well as denominator. But given the guidance given by a lot of the listed entities, the numbers are clearly likely to worsen, at least for the second half of the year, before they probably start stabilizing or improving.
Understood.
Banks, again, it's been a similar number. We are seeing those GS3 NPA numbers in that vicinity of 3% and above for most of them who are pretty active on this space.
Got it. Um, there's a question, a second question from Nikhil, and Karthik, I'm happy for you to answer. Otherwise, I can pick it up. But it talks about how are individuals who lend through P2P faring. I don't know if your coverage extends to P2P or you'd like to comment.
Our coverage as a rating agency, we're not rating any of those entities or those platforms. So I really would not be able to provide any insights. So maybe you could take that question, Nikhil.
Yeah, sure, I'll take that. And to be fair, it's P2P is not a product that Grip offers either. So my information is also a little bit of third party. I think the information that we've heard is that P2P has gone through a lot of change from a regulatory perspective in terms of how investors can invest money, what are the returns they're earning, um, how NPAs are attributed to them. We are not, I don't think there has been a particular difference in the, okay, let me say it this way. I think NPA levels have increased quite significantly. What I'm struggling with is I don't have prior period information because earlier the NPAs were absorbed to some extent by the platforms themselves and not passed on to the users. But the NPA levels that we are seeing currently that are being reported are fairly high. It may not be true across all platforms, but in general there is an increase in P2P NPAs. I think there's a lot of difference between how P2P is structured and how, as an investment opportunity versus something like a corporate bond to an NBFC or a PTC or an STI to an NBFC. So there are various factors that you should keep in mind as you evaluate those opportunities, all in the MFI or NBFC space. A question from Krishna. Is the amortization portion not directly linked to the release of securitization? Krishna, at least to me, that question wasn't fairly clear. I'll
Yeah.
take a shot at maybe restructuring the question for Karthik and we can try to answer that. Um, I think the question is, does the in an PTC transaction, is there a clear amortization policy that is in place at the time of the transaction, and hence, as the transaction moves, is the principal automatically released? Karthik, that's my interpretation, but if you want to answer the question.
So that's how it happens. As the underlying borrowers repay the funds depending on the structure, you'll have the senior investors get paid out first, then the subordinate investors. So as and when the underlying borrowers make the payment, the securitization AUM also starts coming down, because the money then goes back to the original investors, or the holder of the papers.
Yeah. So typically, we Krishna, we see amortization happen from the first month. Obviously, it starts from the first month itself. But what we also tend to see is prepayments, where more loans are being closed, um, or principal is being prepaid faster than expected, and hence the rundown or repayment to investors of the PTC typically tends to happen faster. So there is a documented or agreed on construct, and obviously, as an investor in the senior most tranche, you receive it first. But it often happens that it's faster, reducing the average duration of the instrument. I'll move to the next question from Nagraj. Um, is the data on NP that you're seeing highly correlated, where there are borrowers with more than four loans, which is what you were mentioning, Karthik, earlier, which is about over leverage at the borrower end? Is there a trend that you have seen? I think theoretically yes. I'm not sure if there's data to support it, but is there data points that you can support to show a correlation?
Data points readily not available, but anecdotal evidence and what we hear from entities is that clearly it's the borrowers with more than 3 4 loans. If one was to look at delinquency data that some of them do share, it clearly seems to reflect that such borrowers are seeing slightly higher levels of delinquencies as compared to other borrowers. Another thing that we're also seeing is a lot of these delinquencies are basically coming from borrowers who came into the system about 2 years or 2.5 years back. It's more of a recent borrowers into the formal channel. We're probably seeing some stress over there. But beyond that, maybe some more time before one can actually quantify the data and then put it out to public use.
One of the other anecdotes supporting this is the guidance from the self-regulatory body MFIN, which I think, and Karthik, you can correct me, has specific given guidance for the number of loans to be given per borrower, and I think that's been restricted to
Three
three,
now. To
three
three
now.
now.
So obviously, one of the reasons to do it is probably because NPAs are being seen in borrowers with more than four loans. I'll move to the next question, again from Krishna. Krishna is asking for any specific performance sector-wise and projections. Krishna, I'm assuming this question relates to NBFCs. And Karthik, maybe within the NBFC space, are you seeing any particular type of loans that are doing better than others from a quality perspective, or that you expect to do better in the next quarter?
At this point in time, we were seeing increase in delinquencies sharply on unsecured, small ticket unsecured, MFI. These two segments clearly one is seeing a rise in delinquencies, marginal rise in delinquencies on secured asset classes, but nothing much as such. But in terms of profitability, we do expect a bit of a decline in profitability for FY25 and FY26 as well. Again, driven by largely by one, increase in credit cost across the subsegments that they're operating, and second, more importantly, we would also see a compression in interest margins for these players. As RBI started raising the interest rates 2 years back, all the lenders were pretty fast in transmission of their lending rates to the new borrowers. Whereas on their liability side, the overall cost of funds did not go up so drastically. But now what's happening is we are seeing the rise on the cost of borrowings for these NBFCs, MFIs included. But and given the fact that NPAs are rising and they being a bit cautious, so it's unlikely that they'll be able to increase their lending rates further. So there is a fair possibility that probability that their names will come down over this year and next year. Part of it is already visible in the Q2 numbers. We do expect that to continue in the next couple of quarters as well. And then clearly with credit cost going up last 1 or 2 years, entities also had the cushion of dipping into the COVID related additional reserves that these entities used to make. So that cushion is also depleting to some extent for some of the players. So consequent to which we do expect the numbers to come off. Profitability, if you were to look, our estimate last year, the NBFC sector in general made a profit, had an ROA of in the vicinity of 3 odd percent. We do see that come down by 30-40 basis points for FY25. MFIs, which possibly had the best year in their history in FY23-24, and in terms of overall profitability. They had a profitability numbers of well in excess of 3% at a system level. And the ballpark numbers to compute is roughly interest margins plus fees, let's say 11 to 12%. Your OPEX is around 5. So 12 minus 5, you come to 7. You have about, on an average, on a steady state basis, you're working at about 2.5% kind of a credit cost. You come to 5. 25% goes as tax. So you are in that vicinity of 3.5% kind of a profitability number, with a lot of entities reported in FY24. This year, that 2% kind of a credit cost are estimated is actually going to jump to over 5.5 for this year and possibly for next year as well. So currently our estimate is from 3 plus kind of a return on assets, possibly going to come down to about 50, 60, 70 basis points return on assets for the sector as a whole, with clearly a couple of entities also ending up with losses as well. How much and all depends on what kind of financial strategy they use as far as Q4 is concerned. Do they want to take the entire pain in the current year itself, or do they want to spread it out over FY24 and FY25? I think that's what is going to sort of decide on how the industry numbers look like for a particular period. But clearly FY25 and FY26, one would see muted profitability thanks to the rise in credit cost and the slowdown in growth.
Karthik, is this while probably both factors are going to be true across the industry, is do you see a significant difference in the slowdown percentage between a large NBFC and a small NBFC, or will they all be in the same bucket?
No, large NBFC one. See, one, they were any case not growing at obscene paces at which the small NBFCs were growing, thanks to the denominator effect.
Sure.
The other thing which happens when any sector gets into a little bit of stress, more applicable for the BFSI space, is everybody tries to become a bit more conservative. So you are again, whether you like it or not, you are going towards the stronger guys. So effectively, again, this is a period where you continue to see the strong getting stronger and then the weak possibly getting marginalized. So that's the challenge which the industry faces. You are actually today seeing some of the larger guys also growing fast for a simple reason is they are able to get funds. They are seeing opportunities because a lot of players are slowing down for various reasons. Lenders are also being choosy. I don't want to lend to 10 NBFCs now. I'll restrict my lending to only 4 NBFCs, at least in the near term. So it's like though those entities are seeing pockets of growth opportunities, and depending on their risk appetite, they're trying to capitalize on that. So it's sort of it's very difficult to give a yes no kind of an answer to it. It again depends entity to entity, but clearly access of funds is definitely much more available to stronger entities today than to the others.
Yeah. Eh, like most things in finance, it always depends on a number of things, and you have to just take all of these factors into account. Uh,
No, clearly, it's a very, very confidence sensitive market, whether we like it or not. It's like
yeah,
what we always keep saying. You may be doing right, but if your competitor does something which is not so right, you also need, end up facing those same kinds of challenges till things actually settle down.
yeah, no, very well put. I know we're at the end of our hour, but I just wanted to, we've covered a fair amount of stuff in the NBFC space and then NBFC MFI space. So wanted to thank you for your time. I think it's been great to understand what's happening in the MFI sector. There's obviously been a lot of regulatory action. There's been number of forces at play, everything from interest rates to credit cost to behavior of the user. I think it's very clear from what you described that we are looking at 1 to 2 quarters more, at least, of higher stress, of NPA levels rising. In the last message, you talked about 5.5, 6% from the currently 3.5% levels. And I think it's been interesting to also talk about how different instruments may have different nuances as investors look at this, whether it's P2P, whether it's bonds, whether it's SDIs. And I think it's definitely something for each investor to look at, understand transparently, and then make a decision to invest, whether in MFIs, in other pools of the NBFC sector. I'm sure some of the audience is also looking at this from an equity point of view, and your answers around profitability and ROA would have also given them some indication, some education on how to go about looking at the future performance of the sector as a whole. So, Karthik, thank you again very much for your time. Really appreciate this on a Saturday evening. Thank you to everyone else who's joined us and spared time listening in. We're always excited to bring subjects that are important to you as an investor and talk about them transparently so you can make more powerful investment decisions. Thank you so much.
Thanks, Nikhil.
Karthik, can you just stay on for a minute, please?
Yeah, sure.
Karthik is just finishing uploading, so just bear with us for a minute for the system to finish.
Sure, no problem.
You can feel free to turn off your camera and mic.
Okay.